was amused when David said there that he'd woken up at 2 o'clock in the morning and asked what the hell was he thinking, because that's exactly what happened to me as well today. So thank you all very much for coming. I'm pleased to see the auditorium is probably as empty as I've ever seen it, which is that's a good thing. We'll blame the Piccadilly line rather than the contents of my slides, I would hope. Let me just introduce myself first and who I am, why I'm standing up here in front of you. As David said, my name is Chris Wheaton. I've been an institutional investor in the energy industry now for a decade, unbelievably. I first started looking at the oil industry in all its brilliant, infinite, infuriating complexity back in 2003 when the oil price was $25, and a lot of my colleagues during that year when the oil price doubled to as low a number as $50 a barrel. Remember those fantastic days? Said, the oil price is doubled, it can't go any higher. Absolutely not. But I think we've seen quite clearly that that was very much not the case. What I'm going to do today is, as you see, adapt a presentation I originally gave at a conference this time last year. And all I've done is include one extra slide and adjusted a few comments because what I said there, I believe, still holds. What I'm going to talk about is really a number of things. Firstly, look over the last decade, the period I've followed the industry, try and explain what shareholders like me are concerned about and why, because ultimately, the companies that you work for or you've worked for in the past, they've got to return capital to us as shareholders. They've got to make a profit on the capital we give them, our clients' money that we are entrusted to invest in these companies. A return has to be made on that capital. And that's the whole point that's why it's called capitalism, right? What we're concerned about now and why, and these are all my personal views. If you've got some of my colleagues, my competitors at other institutions up here, I'm sure they'd have some similar views. They'd probably have some quite different views in some cases. And I've also, rather than just throw stones, as David said earlier, let's try and come up with some solutions. I've got some suggestions, some of the things I'm talking to my companies about, and my company management's about, and how we can fix some of the issues that I see in the industry. Exploration and how an exploration process works is a particular bugbear of mine, so hopefully we'll get some questions and maybe a bit of a debate going as to how we can make exploration work better, because at the moment return on exploration capital is appalling. We'll come on to that later on. Let me start the first point now, talk about the 10-year trends in the industry. I'm going to pick on ExxonMobil. Any Exxon employees willing to admit they used to work for Exxon at least? Anyone in the room? Exxon? One person. Fantastic. Exxon's a brilliant, amazing, incredible business. But over the last 10 years, if you look at the breakdown of the economics of the upstream business, so this is just excluding refining, this is just the upstream, you can see a pretty clear and pretty ugly trend as to where the split of the economics has gone. Now remember, in that time, the oil price started on the left-hand side of the chart at $25. The oil price today is $109. And look at the split of economic shareholders. Yeah, with the purple bit down here. That doesn't look great. Yeah, it looks kind of okay, then that doesn't look great, and this looks pretty poor. And if you're wondering why, as David polled at the beginning, you're not satisfied as shareholders, well, there's a great example, because we as shareholders have been squeezed by, firstly, rising tax, certainly in the middle 2000s. Production costs actually haven't gone up that much as a proportion of the oil price. What's really squeezed us, though, is capex. And we've had the huge rises in capital cost in the industry. If you look at the capital employed within Exxon, as you have seen, the second bullet point, it's up 3 times in 11 years. That's a massive, you imagine the compounding rate of increase that is. That's one huge driver of return on, the erosion of return on capital employed, the erosion of cash flow generation, which has become increasingly important to shareholders, and I'll come on to why in a moment. So, as I said, over 11 years, the energy index, this is calendar to the end of calendar 13, the energy index is up 21%, that's for Europe. The Euro Stock 600, that's a broad measure of European stock markets, that's up 55%. the oil price is up 300%. Well, that's not so great. So if you were to look at the industry responses, I quite like David's summary earlier of saying, well, it's shareholders, if share prices haven't performed because it's shareholders' fault for not buying shares. Industry responses to us when we talk about that chart and say, well, look, we've been squeezed as shareholders, return on capital's down, cash generation's down, dividends for a large extent were held across the industry in the late 2000s, early part of this decade, Exxon being a notable exception. The responses come back variably along the lines of, well, it's not our fault, it's the oil price's fault. Which kind of is, to my mind, along the lines of, well, the dog ate my homework. Not quite a response you might have expected. The second thing we've seen as shareholders, apart from the general comments, that first point about the general comments on cost inflation, and that's both operating and capital cost inflation, you've got to build scale. If you have big mega projects, again, picking on Exxon, Qatar LNG is a great example. You get better returns, you get economies of scale. I don't think that's provable over the last, certainly the last 5 years. I think, if anything, there's an inverse correlation between scale and returns. There's certainly an inverse correlation between scale and what I call time to cash, i.e. the point at which a company starts investing in a project and a point at which we as shareholders start getting cash out the other end. And that's one driver of why return on capital employed's fallen so much. The other response is, well, we've got to use more technology. We're going to be more, these are more complex problems to solve, and yes, they are, that I appreciate. But technology, to me, appears to have increased costs and increased complexity, and it's not cut them. It's perhaps made things happen, but it's not made things happen in an economic way. So, the conclusion shareholders drawn is really these 3 bullet points, and there's antipathy, hostility to the energy industry. We've seen a bit of a turnaround in the last 6 months, but if you look at the dividend yields, some of the big oil companies, particularly in Europe, have been asked to pay, or the market has judged, the stock market has judged they can pay. They're quite a bit higher than market averages. If you look at the value placed on the capital employed in these businesses, it's typically at most about 1 times, a little bit more than 1 times. And this is an industry that over the very, very long term, upstream, like 50 years, upstream oil and gas investment has delivered about a 15% return on capital employed, which is what, given the risks involved, you would expect this business should return, this industry should return. What the stock market's saying, though, at pricing that capital at just, at most, its face value, is saying these returns are not sustainable, these returns are going to erode, there is structural deflation in return on capital employed and the cash generation in the industry, and therefore we shouldn't value the capital at more than face value. Secondly, dividend yields are under threat because of the declining cash generation, therefore we should demand a higher than market average dividend yield from what should be much more stable assets than the market average, because as David said, we've seen an oil price that is, I would not use the term cyclical, I prefer the term metastable, because I don't think, given the structural decline rates in oil production and gas and hydrocarbon production globally, I don't think this is a cyclical industry anymore. The point is that the market thinks these dividend yields are more risky than the average, therefore they are higher than average. And that underlines the point. The market thinks this is a risky industry that doesn't make adequate returns. And even the oil services industry, if you go back over 10 years, it's not delivered consistent returns on capital employed. Even sexy bits like, for example, pressure pumping in the US and shale, you've seen price wars there, particularly, for example, say 2011, or going back before then, 2006, 2007. You look at the seismic industry, for example, extraordinary volatility in returns there. PGS, the big Norwegian seismic operator, issued a special dividend to shareholders in May 2008 and had an emergency rights issue in March 2009. It's Now that's a cyclical industry. Anyway, unbelievably, we've made an enormous amount of money in PGS over the years, but more by perhaps luck than my judgment. But don't tell my bosses that. Thanks. Here's a few factors that come across to me as being core, some of the, I think, the core issues about the industry, and they're not necessarily particularly specific to this industry, because you could argue, well, couldn't you apply these to a whole other set of other industries? Well, yes, you could, but I think these are the particular issues for oil, and they are three things. Firstly, complexity. This is a really complex industry that's just got more complex. Secondly, the oil industry appears to think it's different, and I don't know why it should, because the idea of capitalism is that you make a return on the capital given to an industry. Now, if the industry can't make a return on that capital, capital is withdrawn, and that in theory means the productive capacity of that industry shrinks, and therefore pricing rises and return on capital employed should improve. The problem is the oil industry doesn't control its selling price, and that's a bit of an issue, but we'll come on to that. But the oil industry is not different. The oil industry has to return a cost of capital to shareholders over the, I won't say cycle, over the metastable period of time that we're talking about. And I'm, as I said, I've invested in this industry for 10 years, and I've been very happy to wait 3 to 5 years for my investments to work. I mean, Kurdistan, for example, I'm still waiting for my investments to work. Anyway, let's move on. The last point, and this is one point where you could back this point straight back at me as a shareholder, is herd mentality and groupthink. Because if you want to see great examples of herd mentality and groupthink at work every day in real time, just go and look at some share prices, because that's exactly what happens. But it's those, personally, it's those discontinuities that keep me in a job, which is fantastic. But for the oil industry, herd mentality and groupthink is a real problem, because these aren't assets you can buy and sell on a daily basis. If you put, for example, an oil sands mine into operation at the wrong price, it's going to sit there for 50 years, earning you sub-cost of capital returns. That's not great. Now, what's worked instead, I observe, mid and small oil companies. Witness, for example, I'll pick on David again, the great success of Tullow and exploration in the second half of the 2000s. And also, paradoxically, its focus on one's asset type or few asset types and few geographies that actually has worked. And that's a bit of a paradox, because you might argue that as investors, we want a spread of assets, a spread of investments to minimize risk. But actually, paradoxically, for development risk, which is really where I'm talking about, and there's been, as we've seen, a big squeeze on capex, squeezing free cash flow. In turn, it's been concentration on few types of assets that actually have delivered returns for shareholders. So, let me talk about the three factors. Firstly, complexity. Complexity kills. Complexity kills, most importantly, people. And believe me, as a shareholder, I care about that a lot. It kills people, it kills cash flow, it kills profit, it kills return on capital employed. If you can kill complexity before it gets you, fantastic. Now, the typical response for an oil industry, an industry under pressure, where returns are structurally perceived to be structurally declining, would be to merge. Now, if you think of examples, a great one at the moment is the airline industry, for example. The airline industry has just had its most profitable year for 20 years, I think, which is at $110 oil, I think not a bad feat at all. I used to follow the airline industry before I did oil and gas, and the one thing the huge change we've seen in that time has been mergers. You've just put airline after airline together. Some have gone bust. The capital's been removed from some capital's been removed from the system, but we've had consolidation. So in Europe now, you've got big groups centred around Lufthansa, centred around British Airways. In the US, again, you've got centred around Delta, United, American. That's the typical response an industry should come up with. It's about merging, cutting costs, cutting capital, allocating capital better. Problem is, the oil industry can't do that. We've already gone through the mega mergers of 1998. So we've had Exxon and Mobil, Chevron, Texaco. Obviously, the Texaco is now pronounced silently. BP, Amoco, Arco. We've already had that. You can't do it again. If you wanted to get bigger, I think you would be far beyond the efficiency frontier, if you like. And if you want to make businesses really big, it's going to be you're going to have worse outcomes for shareholders. They're going to be harder to manage. So I say that my challenge to the industry, maybe smaller is quicker, cheaper, safer, better. And that quicker point, for me, is really important because, as I said earlier, time to cash has really eroded in particularly the last 5 years. So we're sitting on unproductive capital employed for longer. It's taking longer to get returns for shareholders going. As a whole, returns are diluted, free cash flow is lower. The paradox here, technology doesn't necessarily deliver solutions. I mean, who would have thought that something as simple as 12 million horsepower of pumps would have delivered the US shale revolution that we've seen? 3 million barrels a day of incremental production in 4 years, which I think is a pretty amazing feat. So maybe technology isn't always the solution. I love, some of these big oil company websites. I won't name that company. But they always advertise graduate jobs. Come and work on the most challenging problems in the energy world. And I think, well, yeah, yes, we need challenging. Yes, problems are challenging. But you know what? Maybe actually high-tech solutions aren't the best outcome. Maybe you need appropriate tech rather than high-tech. Which is a neat way of talking about the oil services industry because there's huge amounts of innovation there. If you look at as I said, what the US pressure pumping industry has done, for example, I think is in terms of lateral drilling, now distances up to 2 miles. It's a commonplace event. I think that's absolutely amazing. 3D seismic from the seismic industry opened up huge swathes of resource base, particularly pre-salt. Have the seismic companies been paid for that? Of course not. So, oil services companies haven't been paid for high tech either. My second point, the oil industry is different, says the oil industry. Well, no, it isn't. The oil industry hasn't made an adequate return on capital. This is an industry that too often I see goes back from the price of its outputs, oil and gas, and says, well, okay, we need to make the cost this much, and shareholders end up being shunted right to the bottom of the queue, as I've shown on that graph. Shareholders are at the bottom, because we get what's left after we've paid everything else. So after we've paid the tax and we've paid the maintenance capex, we've paid the expansion capex, we've paid the opex, and dog biscuits and window tax and whatever else, we get left with what's left. When the oil price can't continue to rise forever, this is an industry that has to work, therefore, with the upper bound being an oil price it can't control, and a set of costs in the middle, and shareholders underneath. Now, my challenge to the industry is we as shareholders need more of that pie. Therefore, you've got to challenge your OPEX and CAPEX costs. And the way you do that, I think, is starting to think of the oil and gas industry like a manufacturing industry, not a production industry. Let me explain the difference between those two words. It's like a Coach handbag versus a Tesco carrier bag. They both do the same thing. One is beautifully tooled, handmade, one of a kind, produced by craftsmen, and it's really lovely. And the other one is mass-produced and does exactly the same job and costs very little. My point is the industry needs to do more of the carrier bag and less of the handbag, because the handbag is customized and it's very expensive. The carrier bag does exactly the same job and it's very cheap and it's mass-produced. And I think that point about mass production is one of the things the industry needs to do more of. That the oil industry needs to think like a manufacturing company, and I particularly think an analogy with the automotive industry is where it's really instructive. If you look at the success the automotive industry had of moving towards much more leaner and much quicker manufacturing times in the late 80s and early 90s, and I'll show you a chart in a moment about how that evolution continues today. Shale and the success of shale is predicated on this manufacturing approach. It's doing the same thing over and over again really well and getting those costs down. And I find it amazing that even even today, so 8 years after the shale gas revolution really took off, you're getting 10-15% unit cost reductions year on year in shale gas in the US, and I think that's an amazing number. There's a paradox here, though, that offshore is one of the clearly the growth area for oil production in the next 20 years, if not 50 years. But it's difficult to think about it in a manufacturing way because everyone thinks offshore, it's a fantastic, unique individual developments. I think you can standardise these a lot, and it's very interesting to see what Statoil are now talking about. As an example, they've got clearly they are offshore when it comes to their business, so they've got to make offshore work, and they've thought about this very clearly. When I hear management, cross that they can't get more standardisation, and they're really pushing it, that's one thing I'm really pleased about because I think that is absolutely the approach they need to take here. The problem is, I think, as with my stock-picking individual company choosing hat on, you've got to start from the right asset base, I think. Or there are some asset types that are more amenable to this oil as manufacturing thesis than others. So, if you've got a shale capital, but if you've got a shale resource, fantastic. I mean, look at the returns you've delivered to shareholders over the last 3 to 5 years. Have been, all our shale investments in the US have been absolutely phenomenal. The mirror image of a lot of the major oil companies. Offshore, does that work? Well, we don't know. Don't know yet. But that's one thing that we've got to see more of. And lastly, this point about exploration. What does can we make an exploration process work like a manufacturing process? I think part of the real success of the Tullow share price in the late 2000s was that Angus McCoss, who's the exploration director there, looked like he'd come up with a fantastic process that churned out success after success. And because remember at that time they'd found Ghana in Jubilee field, going around the West Africa Transvaal margin, looking for other fields, which was looking quite prospective at the time, and they found Uganda as well. So, I, as a shareholder, investing in an exploration process rather than an exploration system that just gets lucky, that's what I want to do. And the problem is, I think it's really hard to make a process out of exploration. I'd be very interested to see what the speaker after me is going to say on this topic. I talked about the automotive industry as a great example. Here's a slide I have taken from a Volkswagen presentation. This is actually, look at the date, this is 2011, so this is hardly new news. But look at some of the cost savings they were, 3 years ago they're claiming. If by standardising on a individual platform, which you can then adapt to different cars across not just the Volkswagen brand, but also all their other brands, that you can get 20% reduction in unit cost, 20% reduction in one-off expenditure, so this is sort of variation orders and so on. Variation orders, the bane of the shareholder in the oil and gas industry. Every dollar comes out of our pocket. Let me make that absolutely clear. This is not, a variation order is not a victimless crime. That's a good catchphrase. That's a good line. Engineering content down. So you're talking about a project, a platform that is cheaper, both in OPEX and CAPEX. It's quicker to market because it's less complex. And you've got significant, as you said, they've got significant weight and emission reductions, which fit into the broader, for them, the broader political and environmental issues. I want the oil industry to come up with a chart that looks like that. And that's kind of one reason I come to conferences like this and start talking about this, because it's something that is important to me as a shareholder, because the industry has to work. both for us to earn a return on capital for our shareholders, but also for the industry to keep producing the oil and gas that is still, even if you look at the longer term predictions, even by 2040, will still be 80% of primary energy demand. So, for me, lessons from the oil industry. Firstly, common standards. Can we get some more common standards going for equipment and solutions? Standard responses to, well, if you need to do a subsea tieback, you do this. Off-the-shelf solutions. Supply chain, paradoxically, perhaps it has to become less local, more centralised, more standardised, bigger manufacturing facilities, more long-term partnerships between oil and service and oil and gas companies. So, oil service companies taking longer-term views on capacity addition and knowing that capacity is not going to be switched on and off, but it's going to be used in a consistent way, and that in turn can push down into their supplier chain. I think everyone wins. Lastly, on this point here is an interesting one. The way big oil companies, particularly big oil companies, work, I think you need to get integration between the explorers and the developers and the commissioners actually much earlier in the exploration process. When something gets discovered, developers and commissioners need to be thinking, right, how can we build this and how do we switch it on and how do we build it in the cheapest way, quickest time, and make it work reliably. And I want that as early on in the process as possible because if you look, for example, today, the Catcher development in the North Sea got its government sanction. That was discovered in 2010 by David's new employer, Premier Oil. I keep mentioning you, David. I don't. You're an easy target today. That's 7 years from discovery to first oil. Can we make that quicker? Can we make that 5 years? Can we make that 4 years? My last point, because I'm running out of time. Herd mentality and groupthink. Oh boy, I could go on all day about this because it's what I live. I'm immersed in it every single day. Right. Confession. Fund management in the oil industry here, absolutely no different because we all think the same way. We've all got big planet-sized brain people working for us. I'm an exception, obviously. Where we all end up thinking the same way. What also surprises me is the oil industry is surprisingly insular. It tends to appoint from upstream, so it tends to appoint upstream people to upstream jobs. If you look at some successes, let me pick on Suncor, for example. Suncor has improved its reliability of its oil sands dramatically. It did that because it appointed people from its downstream to run its upstream businesses. And that's, I think, really important. The new guy at the head, Ben Van Beurden at Shell, he used to run Shell's chemicals business. I think the industry needs to look outside traditional sources of human capital for new ideas and fresh thinking. I think the automotive industry could be a really interesting place. I mean, Carlos Ghosn of Renault, for example, what would he do if he ran an oil company? I'd love to see that. And shareholders, I'm afraid, yes, I am guilty of not being good enough at trying to make the oil company, the oil industry work better, because, and I mean these words sincerely, I've said them to company management. This is a multi-decade partnership. The oil industry's been around for 100 years plus. It offers long duration, stable returns, in theory, to shareholders. That's the sort of thing we should be invested in. So, there's got to be a partnership here between shareholders and industry about shareholders helping the industry work better. It's just some examples of groupthink, starting with the obvious ones, TMT bubble. Remember that, the good old days? Equity markets, 2007, 2008, the huge swing up and huge crash. And 2009, the recovery. The stampede into the oil sands in 2005. West Africa, US shale gas. Pretty much anyone who put money into coal bed methane to LNG projects in Australia. Anyway, shale oil, maybe the next one, who knows? But this point here, an investment decision, I'm asking myself this when I'm running the investment fund I run. Why am I any different to the consensus in what I think? What isn't priced into shares already? If I'm making a decision to buy something, why am I different? And that's, I think, a really important point to point to make. Right, let me conclude before I get heckled off the stage. Shareholders in the past have been in the last 10 years have been bottom of the queue for cash flow and profits. We've seen dividends held, for example. Dividends are uncuttable. Let me make that absolutely clear. So that fixed cost has to be taken into account by the oil industry in the future. Therefore, there's no more blank checks for cost overruns because as I said, a variation order is not a victimless crime. Every dollar of variation order comes out of my client's pocket because it's return on capital. It isn't going to me. My second point, oil as manufacturing. Can we turn the oil industry into a manufacturing, not a producing business? Can we stop this customization? Can we make things simpler and quicker and safer? Because, believe me, I think standardization and doing the same thing the same way makes us a safer industry. Herd mentality. I've said kind of all I need to say on herd mentality and the risks there. But this industry needs this industry needs to think differently about the way it works. It needs to cooperate a lot more. I think it's common approaches to common problems, common standards, common techniques, common equipment, common supply chains. Oil services and big oil need to start cooperating a bit more, I think, as shareholders and big oil need to do also. My point is this, this is an industry that needs to change the way it works, and this is what we're pushing for as shareholders because, for the reasons I've explained, the last 10 years have been surprisingly disappointing for us. I'll stop there, probably take questions.
Thanks, Chris. Well done. Okay, any questions? Please, yeah. It'd be good if you would say
Yes, name and affiliation, please, so I can hunt you down later.
Yes, good morning. Howell John, badged as Haven Energy. I wasn't awake at 2 o'clock in the morning, which may become abundantly clear. I was interested in your comments, really contrasting ExxonMobil and Tullow. The inference I would draw from that is that you as a fund manager think that you're better equipped to construct an oil and gas portfolio, or perhaps a broader-based portfolio, than oil company itself.
From the component parts. That's the theory. There's a whole number of macro, bigger stock market effects, particularly in relation to market capital, the size of the companies involved, that can actually make that quite difficult. So yes, you should, in theory, be able to construct a business with better returns and better growth, and get a better share price performance. But actually, you don't necessarily end up with that because, for example, if you're underweight big oil in the US at the moment because you think you can get a better performance out of investing in European oil companies, well, you're going to be losing your clients' money because the US stock market's going up every single day. So, yes, the theory is, your theory is correct. The practice isn't quite as simple as that.
Well, it was the inference I was drawing from what you'd said rather than my theory. I have some sympathy with the view that companies should stick with the knitting and focus in the areas where they have this expertise.
You mean things like, for example, Cretaceous with Tullow, for example? I don't mean to kid you.
Yeah, sounds an excellent example.
If you look, well, the great example of that is shale, clearly, because particularly the most success has been where companies have one shale asset and it's really just understood that and it's refined the recipe. Now, you could argue, well, am I just taking shale and putting this in a context, putting this in context of, or taking it out of context and trying to apply it to a swathe of the rest of the industry? I don't think so, because I think there's broader issues here about standardization and avoiding customization and complexity that apply across the whole industry. Shale is a great example of that, but I think it's an example, it's not the of the underlying theme, it's not the theme itself.
Okay. Anybody else? A whole line of people, so all three.
I recognise Nick. Hello.
Please, again, who you are.
Oh, sorry, Nick, you got queue jumped.
Mick McCullough from Blue Diamond Exploration. You were talking about handbags and should be going back to carrier bags, but what you're missing out there is that the creativity, and that costs money. And if you go back to carrier bags, just producing carrier bags, you lose the creativity, and in the long term, you just end up 100 years later making crap carrier bag, and you've not advanced at all.
If you mean about innovation in the industry and actually being able to fund innovation.
Well, there's innovation. In terms of creativity, the seismic industry hasn't been paid at all for all their creation. But in terms of the industry in general, if you lose that creativity, you lose everything.
I'd argue that the amount of creativity that has been put into the industry has in some way been misdirected. I think creating ever more technologically brilliant solutions to problems may not be the best outcome for shareholders. My point is that if you put some of that creativity into actually standardizing stuff and actually making stuff and making equipment and the processes involved more consistent, and if you look at the amount of intellectual input that went into the car industry to achieve that in the late 80s, particularly in the mid to late 80s and in the 1990s, the amount of innovation that went in there to how you produce cars, how you actually run a supply chain differently. There's real innovation there, so I would disagree with your point that we'd be reducing the amount of innovation in the industry. And I'm not saying that we should pull back from the technological frontiers, because, as I said, something like deep water is going to be 50% of oil growth for the next 40 years or something. So my point is, we can make deep water work better. And that's where I think the innovative thrust of the industry needs to be right now, because it's clear to me that huge advances in things like 3D imaging and ever deeper production systems offshore, for example, have not delivered returns for shareholders yet. What we need to do is take that fantastic innovation and mature it to make it much more like a manufacturing business, because that's the consistency of returns I'm looking for.
Steve Smith, Aikman Exploration Consultants. I'll expand a little bit on that, I think, because I think the issue I feel here is that this manufacturing aspect is a very good view, but applies largely to development of oil, the development phase. You're a room full of people here under the Finding Petroleum label, where quite a few are probably explorers, and I know Mick is, as I am I. There was a concept about business success put forward by an American academic, and I can't remember his name, but he divides it into two parts. If you're going to be successful, you either have to have something unique or you have to be relentlessly efficient. Exploration is the unique bit. Tullow find new plays and managed to grab the acreage in a large extent, especially in the African Rift Valley. And they had a unique niche there that it took other people a time to catch up with. But it only lasts a certain length of time, and then the competition gets in, the acreage is gone, and the story's over. The manufacturing aspect applies to the development concept, where you have to be relentlessly efficient in what you do to make more money than the competition. And I think, it's a very valid point, but if you go back to the 1970s, I worked with a company that was a partner with Conoco in the southern North Sea. They were king of the gas basin at that time. We used to joke that when they made a gas discovery, they looked at the volume in the area and they pulled the appropriate development platform off the shelf and built one, because they knew that industry inside out. They may well have done it, but it was an in-house joke where I worked. I think the shale gas and shale oil revolution is, again, in that context. But whether you can apply it, as you said, to the deep water offshore, where conditions may be different, I really don't know, but I'm a pretty dyed-in-the-wool explorer rather than a developer.
Well, given that most big oil companies are spending typically anywhere from $3 to $5 to $6 billion a year in exploration, and getting honestly not much to show for it, certainly not in the last 5 years, if not longer. Getting exploration to work is something that concerns me, because also there's a broader issue of, well, if you don't find stuff, you can't develop it. So I don't know how you make exploration process work better, and that's kind of one of the reasons I came and stood here today, because I was kind of hoping for some insights from what I hear. What I do want to see is more focus from the industry on just trying to turn this thing into just trying to look at whether you can make exploration into a bit more of a process, because in a way exploration is unique. It is a bit like stock picking. You are to sort of betting tens of millions of dollars of your own money on a stock, or in this case a well, and I don't know, you can do all the problem is the industry seems to have been bad about taking the value add from all the geological work and actually using that to discover, have successes. Notable exceptions being Brazil, for example. But there's still a lot of explorers I meet who don't regard shale, for example, as like real exploration, and I find that bizarre, because it's resource, it's coming out of the ground, it's there, it's oil and gas. I mean, what's wrong with it? So,
I make one quick comment.
go on.
No,
Yes,
sorry.
please.
No, but you're not asking questions. First time you made a speech.
Okay. I apologise if you take that way.
No, sorry, no, it's fine.
Yeah.
Sorry, we can come over fight. We'll get a ring set up later or something. Nick.
Yeah, Nick Way from BP. Chris, great presentation. It sort of resonated with, I think, a lot of very relevant themes. I'm curious by the herd mentality, and as you know from some of my previous roles in BP, I've often had the sense that large companies such as my own listen to investor sentiment around where they're not currently active, and you do see companies often moving late into plays, typically when prices are high, US gas shale being a prime example. A few years later, companies then taking write-downs. I mean, how much of the herd mentality do you think actually comes from the investment community rather than being driven by the companies themselves?
Varies where you are. I think in the US, there is much more of that positive feedback loop you've just identified between supply of capital and the herd mentality, and the shale gas revolution of 2006, 2008 is a great example of that, where companies got paid, could raise any amount of equity in the US to put money into shale gas developments, and it didn't matter what they were. I remember, for example, in April 2008, EOG announcing the discovery of the Horn River play up in the Horn River is the very far northwest of British Columbia, for those who don't know where Horn River is. So it's about as far from a gas market as it could be and still be on this planet. And the shares went up 20% on the day because it was so exciting. There's so much more gas there. Great example there of the cart leading the horse, i.e. the equity investor, giving people money and encouraging the herd mentality, which I think is your point, Nick, that yes, we are guilty of it as well. I think in the US, that's been particularly an issue. And hence my concern, is shale oil the next bubble? Don't know. Was that a reasonable answer to your question? Okay.
Good, I think we need to move on. Chris, thank you very much.
Thank you.